Hey guys, this is Mr. Roxy coming at you live from Palm Beach in Florida. It is already the middle of June, which means it's only another 2 weeks to go till the end of the second quarter for many of the companies that we follow, including, of course, many of the energy companies, including, of course, Occidental Petroleum. But that's not what we're going to talk about tonight. What I want to discuss with you is the Great Recession of 2022. To be or not to be? That is the question that we are going to try to answer. So what I've done is I've prepared a quick presentation for you to see what some of the smart people say, see what the Fed did, and then we can take a look at some of the, relatively speaking, recession-proof stocks that you might be interested in investing in just to help recession-proof your portfolio. So let's get into this and see what's going on in the world where we live today. So just last month, so in May, CNBC, which is a major news network station in the United States, a TV station, conducted a survey. And they do this annually. They started the surveying in 2014, and they call it the CNBC Millionaire Survey. What they do is they invite respondents. In this particular example, for the previous one that they did a month ago, they had approximately 750 respondents. And these survey respondents included investors that have at least $1 million in investable assets. What that means is that these are not people who have a wealth or an effective worth of $1 million or more, which includes maybe a house or a car or something like that. No, these are investors who have at least $1 million in investable assets. As a general rule, these are people with $1 million or more in the market. There is a shift to a very pessimistic and concerned outlook. The respondents were not confident that the Federal Reserve can handle the problem. Well, arguably, you could say, what is the problem? And arguably, again, one can say the problem is hyperinflation. Since the survey was conducted just a month ago, inflation accelerated further, and the S&P 500 slipped into a bear market. A bear market, by definition, for traders is when the market pulls back 20% or more and stays there for a little bit. What are the key findings? So the millionaires, so remember these are 750 people with $1 million or more in investable assets, ranked inflation as the top risk to both the economy and their personal wealth. It's an interesting statement, right? So the one is linked to the other. What is your top risk? Inflation. How does it impact you? Well, it's impacting my personal wealth. Why? Because I have a lot of money invested in the stock market, and the stock market is taking a nosedive. Millionaires are divided on the Fed's ability to slow inflation or reduce demand without causing a recession. More than a quarter of the millionaires believe that the United States is already in a recession, and an additional 34% said the United States will tip into a recession this year. That's a large chunk of the respondents, right? Because more than a quarter, let's make it 26% just to make a round number, plus another 34%, that's 60% of the respondents who are saying we are either already in a recession or otherwise we will tip from a US perspective into a recession this year. It is the first time since the survey began in 2014, so it's about 8 years old, 8 years since they started doing this, that inflation has edged out all the other risks in the ranking. 42%, so close to half, said inflation will last for at least a year or two, and an additional 19%, so there we go, over 60% again, said it will last more than 2 years. So the millionaires who are invested in the market feel that we are already in a recession, and in addition to that, it's going to last a year or two. 35%, so 1/3 of them said they are not confident at all in the Fed's ability to manage inflation. And about half of them said they were somewhat confident. So about half, call it 50 plus 35 is 85% that doubt the Fed's ability to either manage inflation or otherwise who say they are just somewhat confident that the Fed has the ability to manage inflation. It's interesting, in the United States, of course, we slice and dice everything based on a whole variety of different metrics because they want to divide and conquer. And there we have the next line, which says political affiliation. Most Republican millionaires say that they are not at all confident in the Fed's ability to manage inflation, while most Democrats say they are somewhat confident. So arguably not much of a difference there, but hey, you know what? If you can divide and conquer, have your way and keep doing it. 25% already believe the US is in a recession. Only 21% of the respondents said the US is not heading for a recession. So by far, a greater minority of respondents said we are not going to have a recession in 2022-2023. Millionaires own about 90% of all the individually held stocks in the United States. So far, they aren't panicking or selling, according to the survey anyway, and most are raising more cash and moving money into short-term fixed income investments, and given the rising interest rates. So these are, of course, things that you can do as well. If you want to mimic or copy what they do, in the first place, don't panic or start selling. And then you can also raise more cash by perhaps liquidating some of your positions on which you have a very, very nice profit. And in addition to that, you could also move money into short-term fixed income investments, otherwise just equities that pay a higher rate on a dividend on an annualized basis. 40% will make or have already made changes to their portfolio. 44%, nearly half of them, have increased their cash allocation. So here I'm telling you what the millionaires are doing, and you have the ability to copy if you like, in terms of saying, hey, if these guys are doing it, I can do the same, because you can do all of these things yourself. 41% purchased more fixed rate investments. 35% purchased equities. Now, I have shared with you over the past few weeks or so that there are a couple of stocks that I actually have been buying. One of them is Petrobras because it's relatively inexpensive despite the macroeconomic risk. And the other one is Home Depot for a different reason. I'll come back to that one at the end of this presentation when I share some stocks that you could potentially buy to help recession-proof your portfolio. Typically, wealthy investors are the first to take advantage of market declines, looking for distressed opportunities and good value. Well, that's usually what happens in a typical cycle, but in this particular instance, it has not happened yet. The last time we saw this was in April 2020, after the market had taken a nosedive at the time when the coronavirus pandemic kind of hit in full force and the market plunged almost 40%. Vultures, including people like me, were just sitting on the fringes waiting to feed off those low price stocks as they plunged. And then, of course, we snapped them up. What we are seeing now is that the wealthy investors are not diving into the market to take advantage of these market declines. And that indicates to us that there might be some more pain ahead for the market, and also in terms of interest rates. We know these things, those are two separate comments in one sentence, but I don't believe we have hit the bottom yet. And in addition to that, we have not hit the ceiling yet as it comes, or as it relates to interest rates. 60%, or 58 to be exact, almost 60% of millionaires expect the economy to be weaker or much weaker by the end of this year, which is 2020. Most expect the S&P 500 to end the year down double digits. More than half of the respondents expect the S&P to be down 10%, and as many as more than 20% of the respondents expect it to be down at least 15%. Now, currently, based on these year-to-date starting number, the S&P is already down 20%. So effectively, you can reverse engineer this and say the respondents are actually expecting a little bit of an uptick and a slight recovery from being negative 20% to perhaps being down 15%. Ratcheted down expectations for their own investment returns, though they are still more bullish on the returns than the overall market. 25% expect to post negative returns. That's a big number. So a quarter of the respondents are actually expecting to take a loss on paper this year. Remember, you only lose money if you actually sell at a loss. If you have a loss on paper, that might be horrible for you to look at, but at the same time, that might be when the best buying opportunities are available for you to explore. Most of the respondents expect returns of less than 4% of the year. And last year, they expected returns of 6%. Now, that might not sound very meaningful, but remember that if you are expecting a return of 4% and last year was 6%, that means your last year's expectation was 50% higher than this year. What do the bank executives say? Now, the CEOs of major banks have a better insight regarding the economy than most people. In fact, arguably, the CEOs of big banks, especially in the United States, arguably have a better insight into what the market is going to do or what the economy looks like than perhaps even the administration or the Federal Reserve. They don't necessarily agree with one another. The state of the US economy is a mix currently of strong data and alarming signals. The unemployment rate is 3.6%, which is near a record low. That is not a correct number. It's not a true number, but it is the government statistic. So we'll go with that for now. But the way that they've manipulated the number in order to suit their purposes is just part of the state propaganda. Consumer spending and industrial production data have been strong all year. That is correct and true. Existing home sales started slowing in April, but home prices are still rising. I'm not sure they are still rising. They might be stagnant right now, but I do expect we'll see a bit of a decline, especially as the interest rates start rising. I don't think it'll be a collapse. I think the situation in the United States will just cause existing home resale sales to be perhaps repositioning at a slightly lower price. And despite all these better insights or better metrics in terms of how you want to rate it, there are warning signs that a slowdown is pending. Inflation hit 8.6% in May. This is also factually incorrect because a better number to look at rather than the Fed's inflation rate is a CPI number, for instance, which is the Consumer Price Index, or otherwise you can just look at the actual basket of goods that people consume on a regular basis. When people are paying as much as 100% more year over year for gasoline in terms of filling up their car, and when people are paying between 50 and 100% more for food, then the inflation rate at 8.6%, according to the official statistics, is actually somewhat laughable. Food energy prices are surging, actually they're soaring. The supply chain disruptions are happening right across the globe, and the war in the Ukraine further complicates the picture. Stock and bond markets are struggling, and there's trouble ahead, and they show you that there's some trouble ahead. It's an indicator that you can look at. The S&P fell into a bear market. I mentioned that earlier. It's down more than 20% from its recent high. We'll take a look at that one in just a second. And nervous investors pushed the yield on the US 10-year Treasury to its highest level in more than a decade. So what do the big guys, the big bosses at the banks say? I think this is among, if not the most, complex dynamic environment I've ever seen in my career, says Goldman Sachs Group President John Waldron. There's a hurricane out there and it's coming our way, says JP Morgan Chase Chief Executive Jamie Dimon. It's going to be hard to avoid some kind of a recession, says Wells Fargo CEO Charlie Scharf. The US might skirt a recession, but Europe is heading for one, for sure, says Citigroup head Jane Frazier. The likelihood of a US recession is 50% based on historical experience, but I am pretty relaxed about the possible impact, says Morgan Stanley's Jim Gorman. The odds of a recession or weak economic growth are reasonable, which means more caution from corporate executives is warranted. If you are running a significant enterprise, you have to be looking through a lens with a little bit more caution right now than what you might have been, or that what might have been the case when we were sitting here a year ago, says Goldman CEO David Solomon. Of course, one of the challenges that you have there if you're running a significant enterprise is debt, because if you're carrying a lot of debt, you also have to service the interest on that debt, and the interest rate is rising. Spending is growing faster than inflation in all categories besides gasoline. So of course, if you've been an investor in energy like we have been on this channel, all 3,000 crazy dudes like you are, you've been invested in energy and you've done well. So spending is growing faster than inflation in all categories except or besides gasoline. And our customers aren't talking about a possible recession, says the Bank of America CEO Brian Moynihan. Now, if your customers are not talking about a recession, Mr. Moynihan, you should probably do a better job about in terms of keeping them informed. How about companies and investors who are trying to adapt? So Target, of course, Target just crashed a couple of weeks ago and when it went down 30% in one day. Recently, they issued a profit warning just last week after a drop in consumer demand for products, which left them with unwanted inventory. Right now, Target is one of the largest retailers in the United States for the people who don't know. Right now, Target has pretty much got a discount on everything in their store to increase their revenue. Never mind the profit, they just want to make some money. How about Microsoft, international company, right? Profit would be lighter because of a strong dollar and an unfavorable Forex rate. It's a warning sign for companies that do business overseas. Unlike my previous example of Target, Microsoft is very much a global company and Target is not. American Express CEO Stephen Scory said, well-off shoppers are keeping up with their payments. So far to date, according to American Express's CEO, no one's defaulting or there's no delinquencies on their payments. However, you got to keep in mind that American Express has some really wealthy, well-off clients, which is not the same, or it's not true in the same manner for, let's say, Visa or MasterCard. Most people who have American Express cards in their wallets are reasonably wealthy. Consumers have approximately 6 to 9 months spending power in their bank accounts, says Jamie Dimon of JP Morgan Chase. This is another thing that you can do in order to recession-proof yourself and put yourself at less financial risk. Make sure that you have approximately 6 to 9 months worth of cash in your bank account. So what did the Federal Reserve do today? I'm nearly done here, and I'm going to wrap it up and give you a couple of stocks that you could possibly look at investing in. Stocks were higher in choppy trade. I'm going to show you that in a second. After the Federal Reserve pulled the trigger on a 75 basis point rate hike on Wednesday, that was today. It was the highest rate hike in 30 years. And they're working to quickly quell inflation that is proven hard to tame from a 4-decade high. 40 years we haven't seen inflation like we're seeing now. The Fed now expects rates to climb to about 3.4% by year-end 2022, and in 2023 end near 3.8%. That is much more normal, by the way, and certainly better for the economy as a whole than interest rates at zero. So it's not necessarily a bad thing. But this one is necessarily not good. The economy, according to the Fed, is going to slow to approximately a 1.7% growth rate, which is almost nothing. Tightening in financial conditions in recent months should temper growth and help bring demand into better balance with supply. Similarly, large rate hikes likely wouldn't be common going forward, said Chair Jerome Powell today. What about that little bump? So that little bump is over here in the bottom right-hand corner. This was the incredible bump we saw after the Fed increased the rates today. Now, keep in mind that this is the S&P 500, which is down more than 20% year to date, and a long, long way from that 4,800. So 4,800 was where the index was at the beginning of January 2022. Now it's down 1,000 at 3,800. That's where the S&P 500 is. It will be interesting to see when or if we cross 4,000 again during 2022, if we get a little melt up or bounce back after the big drawdown from the past few weeks. Now, I promised you 7 stocks, or I promised you a few stocks anyway, but here's 7 stocks that outperformed the S&P 500 in both 2008 and 2020. Now, of course, 2008 was the big financial crash, right? So the big housing market crash, the big financial crash of 2007, 8, 9, etc. And 2020 was the big flash crash for the coronavirus pandemic, but we recovered pretty soon after the March-April crash, and the market had soon regained the losses from that period of March-April. But anyway, here are 7 stocks, according to CFRA analysts, that are relatively speaking recession-proof. Now, you may notice I lumped a couple of them by color coding them because they are sort of the same type of businesses. From a retail point of view, if you're a US investor or if you're an international investor and you invest in US stocks, Target and Walmart are the same types of businesses. Personally, I would rather own Walmart before I own Target because Walmart actually has an international footprint and Walmart is significantly larger than Target. In addition to that, people are people and people have to eat, and Target and Walmart sell food. So if nothing else, you as a consumer, if you live in countries where these superstores have shops, know that you can get, relatively speaking, discounted foodstuffs at Target and Walmart. So those two are kind of the same, so that's why I lumped them together in yellow. The other two I lumped together is Lowe's and Home Depot. Now, once again, for the international audience, these are 2 mega stores that sell home improvement, DIY, do-it-yourself type products. They sell anything from tiles to appliances to electrical and plumbing repair stuff. So if you need to fix something in your house, you would go to Home Depot or Lowe's. if you live in the United States or perhaps Canada. And you might have seen some of these stores in other countries as well. Maybe you're not familiar with them, but anyway, much like Target and Walmart, these are massive retail companies, and they have a huge footprint. Of the two, I would rather own Home Depot than Lowe's. In fact, just over a week ago, I actually made a video saying why I am buying Home Depot. I'm kind of working to recession-proof my personal portfolio. Those companies are the same, or more or less the same in terms of what they do and how they work. I would rather have Home Depot than Lowe's. I would rather have Walmart than Target. I don't particularly want to own Abbott Laboratories. I don't really want to be in the healthcare sector right now. There's too much friction. There's too much stuff going on as it relates to the vaccines and things like that. But Abbott is a good bet. If you want to get into a healthcare stock at all, if there's a bit of a pullback on Abbott, you might want to buy that one. The one I highlighted in green for all of us green energy gurus here on Investor is Next Era Energy. Now, you may know from watching my videos before that I own a company out of Canada called Enbridge. Enbridge and Next Era are very similar from the point of view that they are not only energy producers, pipeline owners, even renewable owners like solar fields and things like that. But in addition to that, both these corporations that I just mentioned, Enbridge and Next Era Energy, by the way, Enbridge is not on the list because it's not a US company, although it trades in the United States on the New York Stock Exchange under ENB, Enbridge. Of the two, once again, I'd rather own Enbridge than Next Era Energy. The reason why it's so attractive is because both Next Era Energy, where I live, is Florida Power and Light, which means it's my utility, much like Enbridge is the heating and cooling utility for the province of Ontario in Canada. That means that in addition to being fully integrated energy companies, these are also utility type companies who actually get a check every month or payment every month from people like me when you pay your lights and water bill or whatever the case might be. In my particular instance, I use Next Era Energy, also known as Florida Power and Light, as my local utility for electricity. In the case of Enbridge, more than a third of Canada's population live in Ontario, and they pay Enbridge for heating and cooling. Believe it or not, Canada might be, to you, a frozen country up north, but in reality, they have summers that are hot and humid, and from time to time, it's just as hot in Toronto, Canada, as what it is in Panama City, in the country of Panama, close to the equator, from time to time, not always. And in Toronto, it might only last for 2 days, but the fact of the matter is, when you cool your house, you pay Enbridge. When you heat your home, you pay Enbridge. So what it does is it gives you an automatic hedge against market volatility. In addition to that, my stock Enbridge pays me a dividend on an annual basis that yields more than 6%. So I like it for many, many reasons, but these stocks are relatively recession proof. The one that I did not talk about right at the top of the page is Synopsys. This is a company I do not know well, so I'm not going to go there. I know they don't pay a dividend. What I do know about Synopsys is a couple of years ago during the flash crash of March, April 2020, Synopsys was on sale at about $100. And right now it's trading at around $300. So if you had bought it for $100, you're up 200%, and you're probably not too unhappy about that. So guys, that's like an overview of the market. So what I've done is I've given you a bit of background in terms of the recession. Are we going into a recession or not? What do the bankers say? What did the Fed do? And a few stocks that you can potentially look at buying in order to recession-proof your personal portfolio. So that's a wrap on this video. I did want to talk about it because this is a macroeconomic issue that impacts every single one of us. So I don't want to just let it be. I am not selling anything right now. I am potentially looking at adding to some positions. I'm very, very cautious. I hold more cash than usual. And what I would do is say, I'm not sure we've hit the bottom yet, so I'm not going to jump in boots and all, but I do nibble on the fringes. So what I can do is look at my portfolio and say, where can I do a little bit of balancing or rebalancing, just in terms of checking to see that I don't have some outsized positions that are maybe profitable, where I can take a little bit of profit, convert that into cash, and then sit on that cash, which is always cash awaiting investment. And while I sit on that cash awaiting investment, I look for companies that are pulled back sharply. So Home Depot is an example. I don't have a compelling reason to invest in Home Depot other than what I just shared with you now and perhaps the previous video. But the fact of the matter is, just a few weeks ago, Home Depot was a $400 stock. and now it's trading for less than $300. Now, there's no reason to jump into any of these stocks, but I've given you some food for thought, and maybe something that you can think about in terms of where you want to be and how you could possibly work to recession-proof not only your portfolio, but also your personal financial position so that you don't put yourself at risk. So guys, this is Mr. Roxy signing off, saying thanks for watching. I'll talk to you soon. Bye-bye.